Good morning, it's Chad Seay from Seay Real Estate here in Richmond, Virginia. And what I'd like to talk to you about today is mortgage insurance. Mortgage insurance, I find, sometimes gets misunderstood. In fact, I'd say oftentimes people don't really understand what it is prior to entering the home buying process. And even after they've entered the home buying process, sometimes there's some uncertainty regarding mortgage insurance. The way it works is normally before an institution loans you money to buy a house, unless you put 20% or more down on that house, they're going to want you to have mortgage insurance, something that protects them in case you ever default on your loan. You don't make your payments. They want to know that they can get their money back, and mortgage insurance helps them to have that assurance. Now, there's exceptions. Every now and then there'll be a lender who will come out with a program whereby they'll offer a loan with less than 20% down and not require the borrower to have mortgage insurance. But that's the exception, not the rule. Most of the time, you just have to have it. There's often an upfront premium. There's a part of your monthly payment that can be applied towards mortgage insurance. Many loan products have a rule where when you have paid your loan down to a certain percentage of the value, you can stop the mortgage insurance, the monthly part of that premium, and you don't have to have it anymore. There are other loans like FHA, which at this point in time, you cannot get rid of that mortgage insurance for the life of the loan. Now, it hadn't always been that way, and it might not always stay that way, but that's the way it is today. So mortgage insurance can be called different things depending on the type of loan that you're getting. Conventional products typically call it private mortgage insurance. This FHA loan that I mentioned, it's a mortgage insurance premium. So you might hear it called PMI or MIP. Same thing, really. If you're getting a VA loan, it's referred to as a funding fee. So different terms, but the same thing, mortgage insurance. Protects the lender if the borrower does not make the payments. Sometimes people confuse mortgage insurance with a product that's not required. You don't have to have it, but it's mortgage life insurance. So oftentimes over the years, if we mention mortgage insurance, the person who is hearing us and they're just getting started in the process of buying real estate, they think that that's what it is, that it's a little policy that'll pay off your mortgage if something should happen to you, if you were to pass away. And there is such a product. It's mortgage life insurance, I believe is what they typically call that. It's very affordable. And I know my clients, I've had some of them in the past mention that they were going to get it. And if anything happens to either of the two parties, if two people buy it together, the mortgage is paid off. And that's just separate from this. The lending institution won't require that you have it, but you can talk to your insurance agent about it. You might find it's something that you would like to have. And again, when I've seen quotes on those rates in the past, they are typically very reasonable. So anyway, a little insight on mortgage insurance. People like to, if they can, come up with 20% to put down because in the long run it saves you money not having to have that mortgage insurance. The fact of the matter is not many people have that much for a down payment, so mortgage insurance is just part of the game. Ideally, you get a loan where once your value has reached a certain level and what you owe on the house has come down and what you owe represents a low enough percentage of the entire value, you can get rid of that mortgage insurance, not worry about it anymore. So I'm Chad Seay with Seay Real Estate. I hope you have a great week.